It didn't start with a crisis. It started with silence, quiet purchases, hidden shipments, vaults filling faster than at any time in modern history. In 3 years, the world's central banks bought 3,000 tons of gold, the most since records began. Not retail investors, not billionaires, governments. And when institutions that plan decades ahead start moving this fast, they're not chasing trends. They're bracing for a different future. Picture this. It's November 2024, and the second largest economy on Earth just announced a $3.2 trillion plan to escape a trap of its own making. But here's what the headlines missed. This wasn't a rescue package. It was an accounting trick. And the more you understand what China is actually trying to do, the more serious the implications become. Not just for China, but for every economy connected to theirs. This is empire economics, where history and money collide. And today we're diving into the most complex financial puzzle of our time. How did a nation that lifted 800 million people out of poverty in just 4 decades find itself trapped by the very system that created that miracle? And what happens when the world's factory struggles to sustain the growth model it relied on? The numbers are staggering. Local governments across China owe at least 40 trillion yuan in official debt. But that's just what they're willing to admit. Hidden beneath the surface lies another 50 to 60 trillion yuan in what economists call implicit debt. Money borrowed through shadow financing vehicles, off-the-books promises, and accounting gymnastics that would make Wall Street blush. Combined, we're looking at debt that could exceed 100 trillion yuan. That's $14 trillion. More than half the size of America's entire economy, concentrated in a single country's local governments. But debt alone doesn't create a trap. Debt becomes a trap when the very thing you borrowed money to build becomes worthless. And that's exactly what happened to China. For 3 decades, Chinese local governments discovered a money machine that seemed too good to be true. They would acquire farmland from rural families through government-directed redevelopment programs, rezone it for development, then sell the rights to property developers for massive profits. At the peak in 2021, land sales generated 8.7 trillion yuan for local governments. That's $1.3 trillion in a single year, representing nearly 40% of all local government revenue. Cities became real estate companies, mayors became land dealers, and the entire system became addicted to rising property values. The genius was in the structure. Local officials couldn't legally borrow money directly, so they created thousands of local government financing vehicles, shadow companies that could take on debt to fund infrastructure projects. Build a new subway line and the surrounding land values would soar. Construct a new airport and suddenly empty fields became prime real estate. It was a feedback loop that seemed unstoppable. More infrastructure meant higher land values. Higher land values meant more revenue. More revenue meant more infrastructure. Property developers like Evergrande became the middlemen in this machine. They would borrow enormous sums to buy land from local governments, then build apartment complexes to sell to Chinese families desperate to own property. At its peak, the property sector contributed 25% of China's entire gross domestic product. Nearly 40% of government revenue flowed from real estate. Entire cities were built on the assumption that property values would rise forever. But what happens when forever ends? The first cracks appeared in 2021 when Beijing introduced the 3 red lines policy, limiting how much debt property developers could carry. Almost overnight, companies that had been borrowing billions found themselves cut off from credit markets. Evergrande, once China's second largest property developer, later disclosed that earlier revenue figures had been significantly overstated. In 2019 alone, the company overstated its reported income by 214 billion yuan, nearly $30 billion of fictional revenue that convinced investors to lend them real money. When Evergrande faltered, it owed 2 trillion yuan to banks, suppliers, foreign investors, and ordinary Chinese families who had paid for apartments that would never be built. But Evergrande was just the beginning. Country Garden, Kaiser Group, Fantasia Holdings, Sunac, and dozens of other developers followed in a rapid downturn that erased trillions in estimated market value. Suddenly the machine broke. Developers stopped buying land because they couldn't get financing. Land sales revenue for local governments dropped from 8.7 trillion yuan in 2021 to 5.8 trillion yuan in 2023. That's a loss of nearly 3 trillion yuan in annual revenue. Imagine if the United States federal government suddenly lost half its tax income. That's the scale of the crisis facing Chinese local governments right now. Cities that had borrowed money expecting land sales to continue forever found themselves unable to pay their bills. Some local governments began cutting basic services. Heating was shut off in public buildings during winter. Streetlights went dark. Civil servants saw their salaries delayed or cut. The debt pressures had fully materialized. The human cost is staggering. Millions of Chinese families paid developers for apartments that may never be completed. Many households saw the value of their property holdings decline sharply. The Chinese middle class, which had built its wealth on rising real estate prices, watched decades of prosperity weaken. New home sales in April 2024 were down 60% from 2021. New construction starts plummeted 69% from their 2019 peak. This is where the $3.2 trillion plan comes in. In November 2024, Beijing announced what looked like a massive rescue package, 10 trillion yuan over 5 years to help local governments manage their debt. Markets initially celebrated, with Chinese stocks posting their best week since 2008. But when investors read the fine print, they discovered the truth. This wasn't new money. It was an accounting exercise. The plan would allow local governments to swap their expensive hidden debt for cheaper, official debt. Instead of paying high interest rates to shadow lenders, they could issue government bonds at lower rates. The math looked better on paper, but no new money would enter the economy. In fact, the plan would likely reduce government spending as resources that could have gone to schools, hospitals, and infrastructure would instead service old debt. It's like refinancing your mortgage to get a lower interest rate, then calling it economic stimulus. The payment might be smaller, but you still owe the same amount of money. And crucially, you haven't addressed why you got into debt in the first place. This is the structural challenge China is struggling to resolve. The entire economic model depends on rising property values and increasing land sales. But the property sector has faced a severe downturn, and there's no obvious replacement for the revenue it generated. Local governments need money to function, but they can't afford to stimulate the economy because they're already servicing massive debts from the last attempt at stimulus. Meanwhile, the clock is ticking. Hidden debt that officials want to reduce from 14 trillion yuan to 2 trillion yuan by 2028 isn't disappearing. It's being reshuffled. And every day that property values remain depressed, every month that land sales stay low, the pressure increases. But here's what makes this story truly global. China isn't just the world's second largest economy. It's the world's factory, the largest trading partner for over 120 countries, and the engine that has driven global growth for 2 decades. When China's local governments can't spend money on infrastructure, global demand for steel, cement, and copper collapses. When Chinese consumers can't afford to buy imported goods, exporters around the world feel the pain. The question isn't whether China will escape this challenge. The question is, what happens to the rest of us when they try? The ripple effects are already visible, but they're disguised as separate crises. In 2023, China's imports fell by 7.5%. Behind that number are shuttered factories in Germany, empty shipping containers in South Korea, and commodity traders in Australia watching prices fall. When Chinese local governments stop building bridges and highways, the global steel industry doesn't just slow down, it contracts sharply. When Chinese families delay major purchases because their property wealth weakened, auto manufacturers from Detroit to Tokyo feel the effects. This is how debt traps become contagion. The same interconnected global economy that lifted billions out of poverty becomes the transmission mechanism for financial strain. China's local government debt isn't just a Chinese problem. It's a global problem disguised as a domestic issue. And Beijing knows it. That's why the $3.2 trillion plan wasn't really about solving the debt crisis. It was about buying time. Time to transition an economy built on property speculation into something sustainable. Time to maintain stability as millions of families wait for unfinished homes. Time to avoid a downturn that analysts caution could have significant global ripple effects. But time costs money. And money is exactly what China doesn't have. Consider the mathematics of the challenge. Every month that passes, local governments must service existing debt while generating less revenue. The hidden financing vehicles that fueled China's infrastructure boom now demand payments that can't be met. Interest compounds. Obligations grow. The gap between what's owed and what can be paid widens like a crack in a dam under pressure. Some cities have already begun defaulting quietly. Not in dramatic fashion, but through delayed payments, renegotiated terms, and creative accounting that pushes problems into the future. Contractors go unpaid. Infrastructure projects halt mid-construction. Public employees receive IOUs instead of salaries. It's a gradual financial strain hidden beneath the surface of official statistics. The human stories behind these numbers are heartbreaking. In Tianjin, a manufacturing hub near Beijing, construction workers discovered their employer had halted operations without paying 3 months of wages. The half-finished apartment complex they were building stands empty, a concrete reminder of stalled projects. In Zhengzhou, families who paid developers years ago for apartments still visit empty lots where their homes were supposed to be built, holding contracts that have become worthless paper. These aren't isolated incidents. They're symptoms of a system that prioritized growth over sustainability, speculation over production, and political targets over economic reality. For decades, local officials were promoted based on how fast their regions grew, not how stable that growth was. The incentives were clear. Borrow money, build infrastructure, generate impressive statistics, get promoted, and let your successor deal with the consequences. Now the consequences have arrived, and there is no easy administrative handoff left to rely on. The trap wasn't built in a day, and it won't be escaped in one either. China's $3.2 trillion plan reveals a fundamental truth about modern economics. When debt becomes the foundation of growth, every solution creates new problems. Accounting adjustments can buy time, but they can't rewrite the laws of mathematics. What we're witnessing isn't just a Chinese challenge. It's a preview of what happens when any economy mistakes speculation for prosperity, when any government confuses borrowing for building. The question isn't whether China will find a path through this. The question is what the rest of us will learn from watching them try. History has the answers if you know where to look.